Something interesting happened in the markets over the past 24 hours. Everything moved at once. Oil dropped sharply, stocks were surging, Bitcoin has climbed back towards some of the recent highs. At a first glance, it looks pretty simple. Risk goes down, markets go up. Clean, logical, and almost, I would say, reassuring. But when you look a little closer, something doesn't quite line up because markets are not reacting to what has already happened. They are reacting to what they think is about to happen. And that distinction matters more than anything else right now, because if that expectation turns out to be wrong, well, the moves we're seeing today could reverse just as quickly. Let's start with what triggered all of this. The key development was the reopening of the Strait of Hormuz. One announcement and global markets pivoted. According to reports from Reuters, shipping traffic through the strait has resumed after earlier disruptions, easing immediate fears of a supply shock. And that matters, of course, because this is one of the most important energy choke points on the planet. Roughly a fifth of the world's oil passes through it, so when that route is threatened, markets react instantly. Earlier in the week, that's exactly what we saw. Oil surged as traders priced in a disruption risk. As noted by Bloomberg, crude spiked on fears that escalation in the region could restrict supply flows, and the move was fast, aggressive, and pretty convincing, and of course, completely irrational. But now the situation has shifted again. With the strait open again, supposedly, that immediate risk has been reduced, and as soon as that headline hit, oil dropped very, very sharply. Not gradually or cautiously, quickly. That kind of move tells you something important. The market is rapidly removing the worst case scenario from its pricing. But here's where things get more complicated again. The underlying situation has not actually been resolved at all. Coverage from Al Jazeera highlights that while ceasefire discussions are ongoing, tensions in the region remain fragile and unresolved. The ceasefire is delicate, negotiations are uncertain, and military positioning has not meaningfully changed at all. In other words, the risk hasn't disappeared, it's just been pushed slightly further out. And yet markets are behaving as if the problem has already been solved. That is the first major signal. Now let's talk about why oil matters so much here, because oil isn't just another asset, it feeds directly into inflation. According to analysis from the Wall Street Journal, energy price swings remain one of the most biggest drivers of short-term inflation expectations. When oil rises, energy becomes more expensive, transport becomes more expensive, and production, you guessed it, becomes more expensive. Everything gets tighter. And when inflation rises, central banks have to stay restrictive. Higher rates, less liquidity, and liquidity, as we know, is what drives risk assets. So when oil drops, the entire chain starts to reverse. Lower oil means lower inflation pressure. Lower inflation pressure increases the chance of easier policy, and easier policy will support risk markets. Stocks, crypto, all of it. Now let's bring Bitcoin back into the picture, because Bitcoin didn't explode higher during this move at all, really. It kind of didn't need to. It's been climbing steadily and quietly in the background, almost tentatively, as the rest of the markets seemingly moon to the upside. According to market data cited by CoinDesk, Bitcoin rebounded alongside easing macro pressure, holding key support levels rather than breaking down. And that kind of move tells you something different, I would say. Sharp moves are emotional, they're reactive, they're driven by liquidations and market jumps. But slow moves are more controlled. Bitcoin dropped during the escalation and then it found support, and then it's actually started to recover as oil fell. That tells you sellers are no longer in control, but it also tells you something else. Buyers are still cautious. This isn't full confidence, it's positioning for the potential future. Let's take a look at equities, because this is where things get even more interesting. Stocks didn't just bounce, they rallied hard. The Nasdaq is at an all-time high. It's pushed higher considerably, in fact. According to CNBC, tech stocks led gains as investors rotated back into risk assets following the drop in oil prices. At the same time, capital has started flowing back into equities again. That's not just retail traders chasing momentum, that reflects institutional positioning as well. Large players are stepping back into the fray again. But carefully. This is not a panic rally, it's not chaotic, it's controlled. Positioning before a potential ceasefire pump, I would say. And that creates a very specific kind of environment. One that can move higher, but without strong conviction underneath it right now. and that is where the risk begins. Because when a market moves on expectation rather than confirmation, it creates a gap between what is happening and what is being priced in right now. And as we've seen many times in the past, pricing in an expectation and then seeing it unresolved, buying the hype and selling the news, can cause for some big volatility in markets, including Bitcoin. Right now, markets are pricing in a relatively smooth outcome, that tensions ease, the negotiations progress, that stability returns. But none of that has actually been confirmed, and that means this entire rally is built solely on belief. As some analysts noted in the Financial Times coverage, recent market moves appear driven more by sentiment shift than concrete geopolitical resolutions at all. Now, to be clear, this kind of behavior isn't unusual. Markets often move ahead of reality. They anticipate outcomes, sometimes correctly, sometimes not. The problem is when they move too far too quickly, because that's when they can become vulnerable. If the expected outcome happens, the rally continues, but if it doesn't, the adjustment can be sharp. So what does that look like here? If tensions escalate again, oil will move higher. If oil moves higher, inflation's expectations rise, and as we know, if we increase inflation, rate cuts get pushed further out and everything tightens up again for liquidity. Equities will likely pull back and cryptos will follow, just like they have before. So this is the position markets are in right now. They are making a bet, a very specific one, that the situation improves, stability returns, that this relief is not temporary. And for now, that bet is working. Bitcoin is holding stronger. Stocks are pushing towards all-time highs yet again. Oil is stabilizing. Everything looks aligned, but it is all built on something that hasn't fully happened yet, and that is the key point here. Markets are not trading reality right now, they are trading probabilities, and until that probability becomes certainty, the entire move remains exposed. So this is where we are, a market that is optimistic but not fully convinced, a rally that is real but not fully confirmed, and a situation where one headline could still change everything. That's why the next few days matter so much, because this is where we find out whether markets were early or simply wrong. Thank you for watching.